All right. Hi. Hello, everybody. Welcome in. Welcome to the Ecology Center's estate planning webinar. We're super glad to have you with us today. Before we get started, just a heads up that the webinar will be recorded. We're also going to have a live Q&A toward the end of today's program. So please feel free to submit questions at any point using the Q&A feature in Zoom, and we'll get to as many as we can. We're fortunate today to be joined by three local experts who have generously offered their time and expertise. Alexandra Ayoub and Rachel Dodson of Ayoub and Dodson, experienced estate planning and probate attorneys who are going to walk us through the legal fundamentals of estate planning. And Brian Kozel, the Chief Investment Officer at North Berkeley Wealth Management, who's going to be discussing financial planning considerations and how charitable giving can fit into an overall financial plan. So before we hear from our panelists, we're going to turn it over to Martin, the Executive Director at the Ecology Center, to share a little bit more about why we decided to offer today's conversation.
Thanks, Sarah. Hi, everybody. Thanks for joining us today. Um, I'd like to really thank you all for taking the time to spend on this important topic. Hope that you are able to gather some information and resources in thinking about your future planning. I want to thank some of you I know are longtime Ecology Center supporters and for many decades or many years have supported us, and also want to recognize those folks who are new to the Ecology Center and maybe thinking about planning for the future. This webinar is really about providing you with some information and resources for making sure that you are taking care of your loved ones and people that you might want to think about going forward, and also about supporting the causes that you've already shown you care a lot about. And so in honor of National Make a Will Month, we're proud to launch this year for the first time Ecology Center Legacy Circle. It's a new planned giving program, which I'll tell you a little bit more about later. And as part of that launch, we're pleased to offer this estate planning webinar. Today's webinar is an educational opportunity to help you plan for the future, protect the people you love, and support the causes that matter most to you. I wanted to share with you just a little bit about my personal journey in this. And when I grew up in Berkeley, and my mom was a single mom, working mom, and we lived in about 10 different locations in Berkeley before I was 15 years old. And finally managed to land this house. It took my mom, my new stepdad, my grandfather moved in with us, and my godmother, and the four of them together somehow pooled their resources and managed to purchase a triplex in Berkeley, and that's what it took for us to land a property as a family. And this house served us for 40 years in multiple iterations. I lived there later in life with my son. My brother lived there with his kids for a few years. And finally, it took the 40, after 40 years, they always thought this would be their nest egg, my parents. And indeed, as you can imagine, it turned out to be that for them. But it wasn't until they were almost 80 that they started thinking about planning for the future. And so it was this moment that sort of drove them to put together a formal will and a trust and things like that. For me, it was also a real estate sort of instance where my wife and I chose not to get married, but when we joined houses, she had a kid, I had a kid, and we are wedded at the mortgage. Um, that was the moment in which we realized, oh, we have to get our act together about some of this stuff, and we put together formal wills and trusts. And so I just want to say, note that people are at many different levels and come in with different kinds of resources, and there are different life moments that sort of trigger um, putting these things together, but they're really important, and they're an important way to support not only the people you care about, but also the causes that have been important to you. So with that, I just want to, hope that the experts today can help this process be more understandable and answer some questions that might come up. And with that, I really am eager to turn it over to Rachel and Alexandra to get us started with the fundamentals of estate planning.
Great. Thanks, Martin. Okay, let me share my screen so you guys can see my slides. Here we go. All right, are we good? Okay. So, yes, my partner Alexandra and I were really happy to be here. We are partners at Ayoub and Dodson. We are based in here in Oakland, California, and we've been practicing estate planning since about 2012. We are also professors at UC Law SF, which was formerly Hastings, and I am a certified specialist in estate planning and probate. So we've been around the block. We've been at Ayoub and Dodson. We've been together over 5 years now. And just kind of briefly, what we'll be talking about today is kind of a brief overview of what documents make up an estate plan, when you should consider reviewing your estate plan, a few different ways to give to charity, and then what you should consider if you don't have an estate plan in place. Okay, so first of all, let's talk about what is an estate. This is an estate, and if you don't have this, you should leave. No, I'm just kidding. So everybody has an estate, right? If if you own a TV, you have an estate. So it's all of your stuff, right? Estate planning, I think there's kind of a misconception that it's for the rich. It's really not true. It's really an estate plan is for anyone who will die. That is all of us. And it is for anyone who could become incapacitated, which unfortunately is also all of us. That is possible. So planning for your estate plan really is planning for your stuff, but also planning for the possibility that you could become incapacitated. So let's talk about kind of what documents make up a plan.
This is my favorite thing in my office. Well, where there's a will, I want to be in it, which is always my segue into what is a will? What does it do? What's a trust? What does it do? What documents do we need and how do they serve us? And I think that, Martin brought up just a perfect intro into this whole talk, which is that almost all of us, regardless, of what our estate consists of, in California at least, will interface with an estate attorney, whether that's proactively or reactively, because of what Rachel brought to our attention, which is that we're all going to die. Um, so we're the attorneys that, not everybody has to see a criminal attorney or a bankruptcy attorney or an employment attorney, but everyone should probably or will be forced to see at some point a trust and estate attorney. So the point of this talk is to just kind of make it known, or demystify, I guess, what estate planning is and does, and that it's relevant to everybody, and how it can, as Martin kind of teed up here, like impact those around you, those that you love, and the organizations that you care about. So what is an estate plan? An estate plan is a suite of documents that typically consist of irrevocable trust, or wills, powers of attorney, and healthcare directives. I want to also emphasize that all of what we're talking about today, at least Rachel and I, is California specific. So I don't know where everybody is, but everybody has a cousin in Massachusetts that knows better. Or maybe you're from out of state and now you live in California, but this is definitely state specific law. And so in California, the centerpiece of our estate planning work is typically a revocable trust. And I like to describe a trust as a bucket or a basket that you put all your stuff in. So Rachel said, what's an estate? It's your stuff. Okay, so the trust is a bucket that you fill up with all your stuff, your house, your accounts, your TV, what have you. And the trust that you draft, that you work on with a lawyer, and you get that expensive stack of papers at the end of your work together, is the instruction manual that says what happens to the stuff that you put in the bucket, the trust. Okay. The will is typically just a backstop in California that says everything to my trust. It's called a pour over will. this is the typical structure. Okay. I'm not saying that there are people that only have wills and not trusts, or there's other arrangements, but a typical, I'd say, California estate plan is based on a pour over will, capturing what might be left outside of the trust, pouring it into the trust. And then the trust is the instruction manual that says who gets what, who's in charge, what are the terms. Okay. And oftentimes I'm asked, people conflate will and trust together. I need a will, or they say a will, but really in California, you mean a trust. What's the difference? There is a big legal difference, but I'm not going to go into that kind of more academic spiel at the moment. But a trust is critical in California for probate avoidance. If you have a will but no trust, you are saying who gets what and who's in charge potentially, but you are not avoiding probate. And probate avoidance is really the function or the purpose of trusts in California. And for anybody who's been to probate court, you know that you want to avoid it because it takes forever. And by forever, I mean, in a good scenario, 12 to 18 months, like if everything's squeaky clean. And oftentimes it takes 2 years plus to move through the probate proceeding. Okay. It also costs a ton of money. How much is a ton of money? Usually about 2% of the gross value of your estate. So if you have $1 million house, but you owe $900,000 on it, you will, for the calculation of the probate costs, it will be $1 million. Okay. 2% of $1 million is $20,000. So that's, I'd say for every $1 million, think about $20,000 of cost. Who gets that? The lawyers, of course. We wrote the rules. So it's not a tax. It doesn't go to the state. That's also something that people tend to think about. No, it goes to us because again, we wrote the rules. So we have this structure of creating a trust to circumvent the public probate proceeding. Trusts are private. Trusts are administered privately and often way faster and for less money. So that's why the trust is really the centerpiece of this estate plan. The will just kind of is there to support it. The power of attorney and healthcare directive, I'll touch on. Those also support the trust in that they say who has authority to act for you in a range of circumstances, who can step into your shoes. So a power of attorney is for business stuff. It's not for health, it's distinct. And sometimes those two instruments get conflated as well. And there's a lot of different ways that people refer to an advanced health corrective, a living will, a health power of attorney, something like that. But they are two distinct instruments. A power of attorney is you designating somebody to do stuff for you, to write checks for you, to go to the bank for you, to sign documents for you. It is saying, if I'm in the hospital and I can't do what I need to do, Rachel Dodson can act as me in a bunch of circumstances. That is distinct from an advanced healthcare directive where I say, if I'm in the hospital and I can't advocate or say my own medical wishes, I appoint Rachel Dodson to be able to enact or speak for me with respect to my medical wishes. So those 4 documents are the typical foundation of an estate plan. And when you see an estate attorney, we fill in all those blanks, right? We guide you through the conversation of, okay, not only who gets your stuff and on what terms, but who's in charge. That's a really important aspect of the conversation. Who is an appropriate trustee, power or healthcare agent or power of attorney? Who would fit that role best? This kind of comes back to the importance of relying on an attorney as opposed to kind of DIY documents, just because you don't know what you don't know. And there's just too many pitfalls, but our job is to guide you through those conversations of how to achieve your objectives and the best way to do that. And I think that kind of wraps it up. At the bottom, there's a cute little cartoon about the settlor. That's the person who makes the trust, the trustee, the person who's in charge, and then the beneficiary who gets everything. And those roles, mix and mingle. But that's the value of consulting with an attorney to get this suite of documents so that they function the way that they should. And I think that's it for health for the bones of an estate plan. Rachel?
Yes, so I'm about to talk just a little bit more about the different healthcare documents because that people often have questions about that. The only thing I wanted to add to what Alexandra said is that if you have younger children, so kids who are under the age of 18, the will is where you'll name a guardian to care for your children. So that's the one other really important thing
Yes, thank you
that a will can
for
do.
bringing that
Yeah.
up too. That's an important point.
Okay, so healthcare documents. Oh, what's this? Here we go. Nope. Here we go. Okay. So, people are often confused about the different healthcare documents because a lot of different terms get thrown around. So what we currently have in place are advanced healthcare directives. But prior to the year 2000, this was split up between a durable power of attorney for healthcare and a living will. So the durable power of attorney for healthcare was where you name someone to make medical decisions if you can't make them yourself. And a living will is where you would say whether you want organ donation, things about pain management, disposition of remains, other choices that you can make yourself. About 25 years ago, they combined those two to be an advanced healthcare directive. So if you still have a durable power of attorney for healthcare and or a living will, they're still totally effective. It's just that if you update your documents, what you want to have now is an advanced healthcare directive. There are lots of different healthcare directive forms out there. The two that I have put here are the Kaiser form. So that's in the middle. The one in the back was the Kaiser form until a couple years ago. The one in front is the updated form. If you have the old form, it's still totally effective. You don't need a new one unless you want to change who you're naming. And then the one on the left is the statutory form. So this is put out by the California legislature as a statutory healthcare form. You can use either of these forms. There are other forms that exist as well. There's a Five Wishes form. There's a form from the Hospital Association, from the Medical Association. Honestly, you can use any of the forms that you want, and you can fill out your own healthcare directive. And we'll talk about this in a little bit. But if you don't have one in place right now, this is the one document where we'll say you don't need to come see us or another lawyer. Fill out your healthcare directive yourself, and then you can sign that with either a notary or with two witnesses. You don't need both. So that one you can get done on your own. Really quickly, the one all the way to the right, you've maybe seen this before. It's called a post. It's on bright pink paper. It is typically created if you are going into surgery or if you are nearing the end of life. And it is much more limited than a healthcare directive. It only answers three questions. So whether you want CPR, whether you want different medical treatment, um, or whether you want artificial nutrition if you can't feed yourself, and whether kind of what range of medical treatment you want. That is the only thing that form does. Your lawyer cannot make this form for you. This is only something that can be done by a doctor. POST stands for physician ordered life sustaining treatment, keywords being physician ordered. So we can't do those for you. But if you have a healthcare directive, unless you are going into surgery or kind of near the end of life, you do not need to have a post. So those are we've talked now about the documents that make up a plan. So I'm going to turn it back over to Alexandra to talk about if you have a plan in place, when you might want to get that reviewed.
So if you have an estate plan, that's fantastic. But it might be a good idea to have it reviewed. A few slides back, we went over the documents that made up an estate plan, and one was the revocable trust. The keyword there is revocable, meaning that it's meant to adapt, right? You can revoke it, but really you can also amend it. And it's meant to adapt with your life. Life changes, life goes on. And really, when I create plans for folks, I often remind them, just, this isn't meant to be forever and always. This is, until life changes. So keeping that in mind, let's run through a few kind of typical times when you'd want to say, it's kind of like going to the doctor for a checkup. It's been some time. let's check in with an estate attorney, make sure this still functions the way it should. The first is that if you made a trust before 2012 and have not reviewed it, really that's just kind of like this time in the law where there was a massive increase in the estate tax exemption amount. So plans before, let's say 10, 15 years ago were really structured quite differently. Also, it's just been a long time. So anything 10 plus years old, I would have reviewed. You don't need to remember anything I said about the taxes or the date, but really changes happen in the law, even if they haven't happened in your life. And that was kind of a turning point. Significant increase or decrease in wealth, people inherit. You might want to just touch base with an attorney to see how that might be dealt with differently or apart from what you have with your spouse, perhaps, or how it might impact your gifting. Moving to another state, like I said, all the states have really different probate and estate planning laws. So if you do move to another state, you should always consult with another attorney. We have people move, believe it or not, people do move to California to retire. And they often come from, the East Coast, where their planning is just structured really differently. And so just to say, if you have moved from another state, let's say you have a estate plan from Illinois or something, you should have a California attorney take a look at it. If you're leaving for Florida, you should have a Florida attorney look at it as well. Okay. If anybody has died, everybody in your documents isn't there anymore, or it doesn't make sense. Let's say you're reviewing and you're like, oh, I used to love Sally and I gave her $50,000. Now I can't stand the woman. It's like, well, okay, that doesn't make sense anymore. Your kids are now older, passage of time things, a lot of people do an estate plan when their kids are born, to kind of get in the guardianship stuff. And now their kids are in their 20s and some of the provisions don't make sense anymore. You just want to maybe move them into a role of trustee, whereas before you had other folks that might not make sense anymore. Marriage or divorce, that's really important. Being married is a huge legal distinction. And if you've changed your marital status, that's definitely a time that you're going to want to make sure that your estate plan reflects that. Adding a charity, great. Let's talk about how to add charities. Rachel's going to talk about that next. And yeah, just like keep in mind that if there's a time, I always tell my clients, if there's something that comes up in your life and you wonder, oh, would this impact my estate plan? You should definitely get it checked out. And sometimes it's just like going to the doctor and they say, great, no, everything's fine. And you get to sleep better at night. And sometimes it's like, oh no, the law's changed, or yeah, we could do this better at this point. So I'll hand it off to Rachel to talk about adding a charity, because that's the fun part.
Yes, we love talking about ways to give to charity. I am going to be covering different ways to give at death, and Brian will talk about different ways to give during life. There are lots of ways, and I think probably Martin will also be talking about this at the end, but there are lots of ways that you can give to charity at death. My personal favorite is to name them in your retirement accounts. There are many reasons for this. One is that unless it's a Roth, if you have a 401k or an IRA or a 403b, there's all these numbers and letters. When you take the money out of that, you will pay income tax on it because you haven't paid income tax on that money. If you give that money instead to charity at your death, they don't have to pay income tax. So you are effectively giving them more money than you'd be able to give to somebody else because they can take all of the money out of that account and not pay any income tax on it. So that's really great. Another thing that's nice about it, I know Alexandra and I are delightful and we'd love to talk to all of you. And we know that legal services are expensive. You don't want to call us every time you've changed your mind about a charity. The retirement accounts, you're making the designation directly with the asset administrator. So let's say that's Charles Schwab. You do a form with them to name these charities as the beneficiaries. If you change your mind, you just do another form with Schwab. You don't have to call your estate attorney to update your trust. You can change the form yourself. So that allows you to change beneficiaries more easily. A third reason I like it is that retirement accounts, look, if you want to name me as the beneficiary of your accounts, I will happily take them. And they are more difficult to administer than some other assets. There's a lot of rules about timing and pulling money out. And if you're naming a charity for that, then the charity is in charge of dealing with that kind of administrative issues. And often they will have a person or department that's used to doing that. So you're taking the burden off of other people that you might have otherwise named. So that's my one of my favorite ways. But just a few other ways you can give to charity at death. I'm just checking the time. Um, you can have a donor advised fund. So this can be an account that you open during life and you can fund it during life if you want, but you can also have it be a place where you are directing assets to go at your death. And what can be nice about those is, maybe you have certain ideas of issues that you care about or geography that you care about, but you don't know exact organizations you want to leave money to. The donor advised fund can be a nice way to do that because you can talk with wherever you set up your fund about what your wishes are, and they can help you allocate, the funds how you'll want them to go. Other options are you can certainly make a gift directly from your trust. So you can say you give a certain dollar amount to a charity or that you give a certain percentage of what's in your estate to charity. And you can just have that be a one-time gift going straight from the trust. You can also hold funds ongoing in a trust. So maybe you say, okay, keep the trust open for 5 years and give these charities 20% each year or however you want to do it. Another option that's a little more complicated, so I won't get too much into, but you can give someone else the power to direct funds to charity after your death. So you can say, okay, I'm going to leave $100,000 to the charity selected by Joe. So that is another option. And then, like I said, Brian will talk about other ways to give to charity during your lifetime. Um, Okay, so this has all been kind of talking about what are the documents, what that make up an estate plan, what they can do, what they can say, and when to review your plan. Now we're going to touch on what you should do if you don't have an estate plan in place.
Do not fret. If you don't have an estate plan, you should really see an attorney, but there's a few things that we always like to convey to folks, which is the first thing is just please don't try to write your own will or trust. There's a lot of programs out there like LegalZoom and Nolo Press or what have you. And those options, I'm not saying that they're bad. They're just really not they're really easy to mess up. Again, it's the concept of you don't know what you don't know. So doing your own will or trust is just such a limited, I would recommend that for like very, very few people. And truly you might be tempted to think something is better than nothing. And that is actually not the case. Doing your own or attempting to do your own documents can often just totally blow up what would otherwise may have been much simpler. I'll tell you what happens if you just die without any instruments. So it's called dying intestate. So when you die without a will or a trust, the statutes, California has a will pre-made for you, which basically follows like a typical order of like heirship. So if you're survived by your parents, it would go to them, or your spouse, it would go to them, your kids, and so on and so forth, siblings. So there is a predetermined way that things go. And sometimes I think people rush to do some makeshift will, and things that I see regularly, I'd say at least once a year, is that they think that they executed a document and it's not actually a valid document. So they'll type up a will and sign it. That's not a will. I won't get into what does create a will, but that's not one of them. So they'll think they have a document in place. It's just not a valid document. Or they'll actually create a valid document that just is terrible. And then you still have to bring it to probate court and unwind it. And it takes forever. So in those cases, perhaps relying on the intestate distribution would have been a whole lot easier. For instance, if you just wanted it to go to your kids or something like that. I wouldn't rely on that either. I think that the point is you should see an attorney. Let's see.
And I'll jump in really quickly, and I'm sure Alexandra gets this too. I'd say probably 3 or 4 times a year, I have a call from a potential client where I am able to say, you really don't need me, and here are the things that you can do on your own. So, that's not never, it's not all the time, but there are circumstances where we can direct you to avoid needing to hire us. But it's not that often. And you
Yeah,
should
I
just
would
usually
say the
find
same.
out.
It's a very seldomly, but sometimes, it's worth the call. It's
Yeah.
worth the call to just know. And then sometimes we can just say, okay, here are the things you can do on your own. Let's say if you're facing, a deadline or something like that. The easy low-hanging fruit is the Advanced Healthcare Directive. Everyone can do that today. Um, Second low-hanging fruit is, like Rachel said, beneficiary designations on retirement accounts. Those are handled through the institution. You can call Brian or your financial advisor and say, can I just double check my beneficiary designations? Those don't pass by will or trust. Those just pass via the whoever's designated. So today, everyone can do a healthcare directive and ensure that their beneficiary designations are set up the way they want them to be. And you can call in a state attorney too. Um, so yeah, something is not better than nothing. Have a consultation at least. And no, you don't always need an attorney, but wouldn't you rather know for sure? And also, I like to say, I always also like to mention, of course, estate planning services, legal fees are expensive, but it actually is really inexpensive insurance if you think of it that way. You've worked your entire life, Martin's mom worked her entire life to get to this house. And you pay insurance all the time for everything else in your life. Like you maybe insure your legacy, ensure your estate gets handled the way it should. Um, and that the cheap, easy ways to do things like adding people to title on deeds and shortcuts of transfer on death, those are really dangerous, and if it's cheap and easy, I would handle with extreme care before you say, oh, I'm going to save a couple $1,000s and do it the cheap and easy way. It's often a disaster on the back end, and people just,
Absolutely.
again, don't know what they don't know. So those are my cautionary tales and things that you can do. Hot tips from Rachel Dodson.
Yes, we have just a couple of minutes left, so we want to give you some of our hot tips. And then we'll be turning it over to Brian. So we already covered this, but one of our favorite hot tips is giving your retirement accounts to charity for all the reasons I already mentioned. Um, Another tip, so this is often for folks who are getting older and maybe want to keep managing their own assets, but want some help or feel like they want somebody looking over their shoulder or yeah, for whatever reasons, you just don't want to manage your assets on your own anymore. One thing that you can do is you can add a co-trustee to start serving with you now or at whatever point you want. So, maybe that's a kid or a trusted friend. You can add them with you, and that can help if you're worried about fraud, like somebody getting you to sign something that you shouldn't have. If you just want help paying the bills and you want to have someone with the legal power to help you, adding a co-trustee can be a really nice option for a lot of our clients. Um, Another thing we really recommend is that when you are naming people in your documents, you are naming people who you trust, and then you are giving them the power to do what they need to do. So when clients start talking to us about, I want to name Susie, but I don't want her to be able to do this with money, and I don't want her to be able to sign that, and I don't want this. That's really a red flag of like maybe you just shouldn't be naming Susie. You should be naming someone you can really trust to help you when it's needed. Um, Pretty regularly, we have people come in who really don't know who to name as a trustee after them. So the person who can handle your assets on incapacity or death. So I like people to know that one option is that you don't have to name someone after you, but you can give someone the power to name a trustee when the time comes. So maybe you're like, I would really like a professional to serve in this role, but I'm 45 and healthy and really don't see a reason to go interview professionals now. You can give that power to someone else, and then they can interview professionals when the time is needed. A big one is to keep a list of your assets along with your estate planning documents because you want folks to know where to go looking for your money. So just at what institutions do you have your accounts? or leave your financial advisor's information and they'll know what your assets are. Um, Sometimes people wait to make an estate plan once they've gotten some bad news. And we can tell you from a lot of experience that it is a lot easier to make your estate plan when you're healthy than to make it when you have gotten a diagnosis. We find that people really struggle to do their plan at that point. So it's really nice to get it out of the way ahead of time. I won't keep hammering on this, but really, please do not write your own trust or your will. Really, really, please. I promise we are not doing that to drum up business. We actually make way more money off of messed up plans than we do off of good plans on the front end. I promise you. But yes, please go do your healthcare directives. So this is us. This is our information. You can call us. You can email us. Here we are. I think that's it. So, Alexandra, unless you have anything to add, I think we'll hand it over to Brian. Okay.
All right. So let me share my screen here. All right. Thanks, Alexandra and Rachel, for that terrific overview. And as Sarah said in the beginning, my name is Brian Kozel. I'm the Chief Investment Officer and Managing Partner at North Berkeley Wealth Management. We're a financial planning and wealth management firm in Berkeley. Been here for a little over 20 years, a team of 16 people. And we have the privilege of working with individuals and families to figure out their financial future. And there's a lot that goes into that. And piece of it is often charitable giving. That's important to a lot of people that we get to work with. So we're going to go over that today. I'm going to go through it somewhat quickly. But really, giving is rarely an isolated decision. It often interacts with retirement, taxes, investments, family support, as well as all of the estate planning documents that Rachel and Alexandra just went over. And it often starts with what can appear at a face value as a simple question, but it's often anything but, which is, how much can I afford to give? And so when we think about this question, and in a second, I'm going to get into ways to give during life. But the first question is really this, how much can I afford to give? And it starts off, as we kind of have this little flow chart here, starts off with security. What does current cash flow look like? What are ongoing expenses? Do you have enough of liquidity or emergency reserves to cover the unexpected pieces of life? We work with a lot of people who want to give, and we want to support them in that. But we don't want that choice of giving today to create anxiety and insecurity tomorrow. So doing that in a well-defined plan often allows you to give with a lot more confidence. The next piece is taking stock of what today looks like is only the first step, because often there's a lot of expenses or considerations in the future. This is one of the things that makes giving through estate planning in some ways the simplest, because when you pass away, you don't need the money anymore. You're giving it to some heirs, you're giving some charities potentially, but you've already kind of had your go on this plane. But a lot of people want to give during their life. I mean, people have the capacity to. But we want that to take into account, what does retirement income look like? What do future expenses look like? Whether those with younger children in college on the horizon and future there, planning for that, only getting more expensive. Healthcare, also only getting more expensive. But thinking through those pieces, both in terms of crafting an estate plan and documents, but also crafting your financial plan for while you're alive. What does that look like within your household, your income, a spouse, future expenses? All of these pieces kind of work together. And when we have the privilege of working with clients, we model this all out to get a sense of what that looks like over time, so that we can see what is the impact of giving now what ripple effects does that have down the road? And then once you've kind of gone through that work, again, you can get to this phase of actually evaluating what is available for you to give now to the causes you care about, such as the Ecology Center. And so one of the pieces before I just transition over here to how to give is that someone could look at their savings and kind of whether that's 200,000 or 2 million or meaningfully more, and conclude that they have substantial resources to give. But that answer looks really different for someone in their 40s or 50s facing college tuition bills and 40 years of retirement ahead of them than it does for someone who's in their 80s. And again, it just needs to be looked at in a personalized way for how that fits into your plan. So once you've had a chance to kind of do some of this work, figure out how much you can give, the next question is how to give. And the simplest method isn't always the most tax efficient one. So we're going to look at 4 different options today. We'll start with cash. So cash is often the simplest way to give, whether that's a check, credit card, pay a donation online. There's no special account or paperwork that's required when you do this. We won't go into kind of larger gifts and gift taxes there towards individuals, but if you're giving a charity, nothing special needs to happen if you're just giving cash there. Moving on from cash, though, in a lot of alignment with what Rachel was talking about, giving from a retirement account can be a really tax-effective strategy. And so there's something called qualified charitable distributions. So if for folks who have an IRA account or had a 401k or 403b or whatever that rolls into an IRA, and who are over the age of 70 and a half, they can do something called a qualified charitable distribution, which means that they can make a distribution from their IRA that counts. If they need to take RMDs, required minimum distributions, it can count towards that RMD. But again, it is a tax-free gift basically to the charity because the charity is not paying taxes on this. And because you are not taking the money, you're sending it directly to a charity, it gets to be excluded from taxable income. And there is a nuance there that these QCDs are actually fully excluded from income on the tax return as opposed to just being a deduction. So it does help keep things like AGI and other pieces down, and that's relevant for a variety of benefits and Medicare and other pieces there. So again, kind of starting off with the simplest option is giving cash. If you are over the age of 70 and a half and have an IRA, then there's some options there for how to give in a really tax-effective way. Next, we'll move on to 2 additional ones that are related here, which is gifting appreciated securities or donor-advised funds. And so we'll start with the gifting appreciated securities. So as we said, when you give cash, that's the simplest way, but it's not always the most tax efficient. So sometimes we often work with folks who have stocks, the most common version here, but it could be more complicated things like gifting an appreciated house or piece of real estate. But focusing on stocks in particular, if you bought Apple or Disney or Google or some big company a long time ago, it has a lot of gain in it now, most likely. And if you were to sell that stock, you pay capital gains tax on the appreciation. And then you could pay some taxes and then give an amount to charity if you wanted to. But the more effective way often is to make a stock donation to the charity. That way, you don't have to pay the capital gains taxes on it. The charity doesn't have to pay the capital gains taxes on it. And you get to deduct the full value of the stock that you donate. So that can be a particularly powerful way to do some tax-effective, tax-efficient giving as well. And then taking that to the next step, donor-advised funds are a special charitable bucket. I kind of think of them as little turnkey family foundations, but it is a bucket where you irrevocably put money into it to give to charity, but you don't have to determine what charities that goes to right now. So this can be powerful at end of life to put money into a donor advised fund, but also during life, you can, as we said on this previous box here, you can gift appreciated securities to a donor advised fund. That way you get a tax deduction, you avoid paying the capital gains, and now you have this charitable bucket that can be granted out over time. And one kind of additional strategy that I'll just mention is that often when people are in a high income year, whether that is selling an asset or right ahead of retirement, you could actually bunch several years of giving into 1 year into a donor advised fund, get a big tax benefit from that, and then still grant it out over multiple years in the future. So could be an interesting strategy there. So again, just to kind of wrap this all up, when thinking about giving during your life and coordinating it with your financial plan, the first thing is liquidity, making sure that you're not giving away money that you need. The second is tax bracket timing. Often our income is not the same every year in our lives. And so timing gifts around higher income years for the highest benefit, or around liquidity events when you have assets to give, that can be a relevant consideration. Asset location, as we just talked about, there's different places to give from. And so deciding that can be really powerful to making sure the charity gets more at the end of the day. And also keeping documents in sync, kind of echoing what Rachel and Alexandra said, making sure beneficiary designations are updated, trust provisions match what your intentions are. All of these documents are working in coordination. And so as I kind of talked about today, charitable giving works best when it is planned, not improvised. And with that, I am going to turn it back to Martin, I believe.
Thanks y'all for all that information. Really valuable and helps to level set for everybody. And really appreciate you taking the time to be with us today. For our audience, you've heard, estate planning is ultimately about making thoughtful decisions that reflect your values and provide for the people and the causes that you care about. For more than 50 years, we've worked alongside community members like you to strengthen our local food systems, advance policies, and protect people and the planet, inspire the next generation of environmental leaders. Most of you, I'm assuming all of you, are very familiar with the work that the Ecology Center does. Planned giving offers you a way to continue to do that into the future, and in some significant ways. I want to just tell you, we had a board member a number of years ago who inherited some stock that she was not particularly happy with the company. She had a number of moral quandaries with them, but she put in that away for the Ecology Center, and or a chunk of it anyways, a piece of it away for the Ecology Center. When we got it, it came at a time that was really critical when we needed to invest capital investment in our operations, in our facility, in our office down at 2nd Street. And yeah, thanks, Sarah. So I'm a little out of cue maybe. That legacy that she put aside for us was something paid for, something that would be very hard to raise money for through grants or contracts or other kind of institutional sources. And it's still supporting the work that we do today, many years later. So just want to note that this kind of giving, when it comes to the organization, can allow us to do some really important and critical things that would be difficult to pay for from other sources. And sometimes that could be helping us with an advocacy campaign that helps to set up future funding from state sources, or really leveraging that money towards community benefit or long-term support for the mission work that we're doing. So I'm proud to bring forward today the launch of our Legacy Circle. This recognizes supporters who have included the Ecology Center in their estate planning, and celebrates their lasting commitment, and hopefully inspires others to consider leaving a legacy of their own. These gifts, as I mentioned, provide flexible long-term support that allows us to respond to emerging challenges and opportunities that come for years in the future. If after today's webinar you'd like to learn more about the Ecology Center's Legacy Circle, we'd be delighted to continue that conversation. And if you think, and if you've already included the Ecology Center in your plans, we'd love to know about that and be able to welcome you into the Legacy Circle and give you that kind of recognition and you know, use that to leverage support from other folks. Sarah Leverton's on the call today. She would be the person to contact about that with questions or simply talk through some options. Of course, there's no obligation. All conversations will be confidential, but just want to invite you to be a part of that. And with that, I'll open it up to questions. And of course, if there's individual questions that you have regarding the Ecology Center and charitable giving, you can reach out to Sarah directly.
Great. Thanks so much, Martin and Brian and Alex. That was wonderful. So I'm just going to read off some of the questions that we got in the Q&A. We had some questions that were submitted during registration, but I think that all of those questions actually got answered during the course of the presentation. So our first question is, what is probate?
Oh, yes, that's a good question. It's the court supervised process of administering an estate. So when people say go through probate, what we mean is filing documents with the court and getting court orders and having hearings at the court, where eventually you get a court order that says, okay, you can distribute the money to these people. So when people say probate, there are probate courts, and we're talking about court filings and other things.
Great, thank you. And the next question is, can't you just put your house in a trust, have beneficiaries named on your bank and other money stocks, and have a will for all of your personal stuff, plus the other documents you named?
Yes, you can just do that. But really you want to funnel, if you're endeavoring to create a trust, you really would probably be best served to have that serve as the instruction manual in a coordinated effort with all of the assets rather than have the trust direct your house and then these other transfer on deaths going out and perhaps not coordinating with the trust to go to whoever. Also with pay on death or transfer on death designations, you can't necessarily have a contingent plan for that. So if the person dies and you don't change it, you know, there's problems with that. The trust is just the best instrument for flexibility and coordinated planning. But the short answer is yes, but it wouldn't be a great plan.
Thanks, Alex. All right. The next one is, how old do you recommend people be to have these documents? 18 plus, 65, particularly the healthcare directives.
Yeah, so you can't have these documents if you're under 18. I do recommend that everyone have a healthcare directive. There is no default for who can make your healthcare decisions if you can't make them yourself. So the only way to get someone named is to actually do a healthcare directive. People are heading off to college like this week, and I've actually gotten 3 calls from friends and clients asking, like, should I have my 18-year-old do a healthcare directive? And the answer is yes. And like we've said, you don't even have to pay for it. Just download a form, fill it out, and they can sign it. In terms of, when do you need these other things? We have our lawyer answer of it depends. We do think everyone should have an estate plan, but there are various reasons why you might not want to make one right now, especially for younger folks. So it does
I think that the typical waypoints that people, triggers like, oh, I should get an estate plan, or having kids, buying a house. Those are usually the 2 that people click in and are like, oh, I should, make sure I have these documents in order. But some people never have a house or kids. That's, but it's like whenever you should talk to a lawyer and see if it's appropriate. But those are kind of the typical times when people start thinking about those things.
Great, thank you. How much does it cost to have an attorney review your trust and/or will?
It depends. It depends on which lawyer you're going to. Everyone's hourly rate's different, and the extent of the changes that might come out of that review are going to vary. So I won't even venture a guess. I don't think it's worthwhile, but it really depends on who you go see and what kind of work needs to happen.
Okay, thank you. And I think this is the last question. They said, I think you said you cannot just type up a will on your own. So what is a holographic will?
Professor Dodson?
Okay, well, a holographic will is a document that you do in your own handwriting and that you sign yourself. I think the point that Alexandra was making then is like there are ways that people can try to do it themselves, but they often mess them up. For example, I just had someone call last week and say, well, we typed up what she wanted and she signed it with a notary. And it's like, that's actually not a valid will. There are very specific um, things that, what is the word I'm looking for?
Formalities.
Formalities, thank you, to make a valid will. And that can either be two witnesses or it can be your own handwriting and signed. And people find all kinds of interesting in-betweens to do. And then maybe you end up in court fighting about whether this piece of paper is a will or not. So, yes, a holographic will is doing it in your own handwriting and signing it. We don't recommend it.
Great. I think those are all the questions. I'll turn it back to Martin to close us out.
Yeah, I just again want to thank everybody for attending and for the long-term support that many of you have given to us on an annual basis or, as life permits. It has really made so much possible. And, the success that the organization has, especially in areas where, other kinds of resources are not available, government grants, which are, are contracts, which is a big part of our organization's budget, but it doesn't allow us to do the innovation. It doesn't allow us to do the policy advocacy. It doesn't allow us to pilot new things often. So, the unrestricted funds that come from individuals are really leverage much bigger, greater success, and we're really grateful for all the support that you have given to us. And we hope that you will think about planned giving as a way to continue to support the organization into the future. I really want to thank Alexandra and Rachel and Brian. You guys are great. We really appreciate you taking the time to share this information. And we hope that them being with us has given you all practical information and confidence as you think about your own estate planning. So, in closing, I just want to thank you again for your partnership, your collaboration, your commitment, your support. This kind of individual support really can be critical in helping us to leverage great other assets and into being able to be around this long, 50 plus years, and to be able to have the success that we have. So thank you again, and I hope you have a wonderful afternoon.
Thank you.
Thanks. Bye, y'all.